Welcome back to the ProTicker Podcast. You're joining us for our Saturday morning edition, where we cover major financial magazine headlines. We've got a pretty wild week to unpack, and I think you'll find this one particularly interesting.
Absolutely. Buckle up because we are going deep into some global economic currents, and they have the potential to really rock your portfolio.
Okay, so let's set the scene. Imagine a giant economic engine, the kind that powers a good chunk of the world.
Yeah.
And it's starting to sputter.
Mm-hmm.
That's China right now, grappling with deflation.
Yeah.
And to make things even spicier, Trump's back in the White House.
Yeah.
Which, always throws a wrench into the global economic machine.
It's definitely a recipe for market turbulence. To get a clear picture of what's going on, we've got a stack of articles from some of the sharpest minds in finance, the Wall Street Journal, Bloomberg, MarketWatch, and Barron's. Different angles, but all pointing to a fascinating and potentially volatile moment in the global economy.
All right, I'm ready to dive in. Let's start with China. The Wall Street Journal's article, China struggles to shake off deflationary pressures as consumer prices edge higher, caught my eye. It paints a pretty sobering picture, right?
It does. The article highlights that while China's Consumer Price Index, or CPI, that's the measure of inflation everyone watches, ticked up slightly in October, their factory prices are still falling. We're talking about 25 straight months of decline. That's not just a blip. It's a trend that has economists worried about a potential deflationary spiral.
Okay, so help me out here. I remember hearing about Japan's lost decades, and I know deflation played a role, but honestly, I never fully understood how that whole spiral thing works. Could you break it down for us?
Of course.
What?
So imagine a scenario where prices keep falling. Sounds good at first, right? Cheaper stuff. But here's the catch. When people expect prices to keep dropping, they hold off on buying things, thinking they'll get a better deal later. This drop in demand forces businesses to lower prices even further to try and attract buyers, but that just reinforces the cycle. Companies start losing money, they cut back on investment and hiring, and the whole economy starts to contract. That's the deflationary spiral in a nutshell.
Wow, that makes it crystal clear. And this is what has people so concerned about China.
Precisely. The Wall Street Journal even quotes Ziwei Zhang, chief economist at Pinpoint Asset Management, saying deflationary pressure is clearly persistent in China. Having an expert on the ground confirm these fears adds a whole other layer of concern.
So what's China doing about it? I mean, they're not just sitting there watching this happen, right?
It's definitely not. Bloomberg has a fascinating article. China unveils $1.4 trillion debt swap saves stimulus for Trump that sheds some light on their strategy. They've just launched a massive $1.4 trillion debt swap program, which sounds like a huge stimulus package. But it's actually more about refinancing existing debt than pumping new money into the economy.
Oh, that's a pretty savvy move, especially with Trump back in the picture. He's never been shy about criticizing China's economic policies, and a big stimulus package could be seen as an attempt to manipulate their currency.
Exactly. And Bloomberg actually quotes Duncan Wrigley, chief China economist at Pantheon Macroeconomics, saying policymakers probably saw no need for a robust response to Trump's victory before he takes office. They seem to be playing a cautious game of wait and see.
Which makes sense. No need to tip your hand before you know what the other player is going to do. And speaking of Trump, his return has definitely sent shockwaves through the markets, hasn't it? MarketWatch summed it up perfectly in their article. The S&P 500 breaks 6,000 and the Dow tops 44,000. Here's why stocks could keep climbing. The numbers are pretty eye-popping.
They are the S&P 500 smashing through 6,000 and the Dow topping 44,000. That's the best week stocks have seen all year. It seems like Wall Street is pretty optimistic about a Trump presidency, at least for now.
Well, yes, those doom and gloom predictions didn't quite pan out.
Not yet, anyway. But remember, this is just the initial reaction. And it's important to keep in mind that this isn't just a U.S. story. Trump's trade policies, particularly those targeting China, could have a massive ripple effect across the entire global economy.
And that's where things get really interesting. I mean, we've got China fighting deflation, Trump potentially throwing a trade war wrench into the works. It's a lot to unpack.
It is. And there's a quote from Tony Roth, chief investment officer at Wilmington Trust, in the MarketWatch article that I found particularly thought-provoking. He says, "The market's not convinced Trump's policies have to be inflationary." It raises an interesting question. What do you think?
That's a good one. And while we ponder that Bloomberg paints a pretty wild picture in their piece, Wall Street bets on new riches ahead and markets all in on Trump, small caps are booming. Crypto is soaring, and investors are pouring money into risky credit. It feels a bit like the dot-com bubble all over again.
It does feel a bit like that irrational exuberance is creeping back in. Remember, small caps are companies with relatively small market capitalizations, meaning they're often seen as riskier investments. And with valuations already sky high across the board, it makes you wonder if things are getting a little too frothy.
Yeah, if Trump's policies don't deliver the promised growth, this party could end pretty abruptly.
Exactly. And that brings us to another key player in this whole drama. The Federal Reserve Barron's has a really insightful article titled, "The Federal Reserve Could Slow the Pace of Rate Cuts Next Year," Powell says. That sheds light on their current dilemma. They just cut interest rates, but Powell's hinting they might slow down the pace next year.
Why is that? I mean, isn't the Fed usually all about keeping rates low to stimulate growth?
Well, typically, yes. But they also have to keep a close eye on inflation. And right now, they're facing a tricky balancing act. Trump's policies, coupled with a potentially strong economy, could easily lead to inflation. And the Fed's main tool to combat inflation is raising interest rates.
So if rates go up, things get more expensive for everyone. From mortgages to car loans, it hits us all right in the wallet.
Precisely. And Barron's captures Powell's cautious approach perfectly by quoting him saying, "Nothing in the economic data suggests that the committee needs to be in a hurry to get there. They're clearly treading carefully, trying to avoid rocking the boat while still keeping inflation in check."
It's like they're walking a tightrope. The market wants low rates to keep the good times rolling, but the Fed has to worry about the long-term consequences of keeping rates too low for too long.
Exactly. It's
Yeah.
a delicate balancing act, and it's made even more challenging by all this global uncertainty.
We've covered a lot of ground here, and it feels like we're standing at a crossroads. On the one hand, you've got this market momentum fueled by Trump's return and the promise of pro-growth policies. But on the other hand, you've got these looming economic anxieties, particularly about China's deflationary pressures and the potential for a global slowdown. What are your thoughts?
It's a fascinating dynamic, and it highlights the importance of staying informed and being prepared for any potential shifts in the market landscape. But that's a conversation for part 2. Stay tuned, folks. It certainly is a fascinating and potentially nerve-wracking time to be following the markets. Where do we even begin to unpack all of this?
Well, I think the key is to remember that even with all this global uncertainty, there are still opportunities out there for savvy investors. But as always, knowledge is power. The more we understand these macro trends, the better equipped we are to make informed decisions.
Couldn't agree more. And one of the most insightful articles we have this week is actually from MarketWatch again this time, titled, "Trump Victory Sparks Seismic Week for Stock Market. Investors Need to Keep Cool." It cautions against getting swept up in the hype, reminding us that election results often trigger knee-jerk reactions that don't necessarily translate into durable investment opportunities.
Right. So how do we as individual investors cut through the noise and figure out what actually matters for our portfolios?
It all comes back to the fundamentals. Look beyond the headlines and focus on the underlying economic data. Are corporate earnings strong? Is inflation under control? Are interest rates sustainable? These are the kinds of questions that will help you make sound investment decisions, regardless of who's in the White House.
The article also makes a great point about how history doesn't always repeat itself, but it often rhymes. If we study past market cycles and understand how different asset classes performed under various economic conditions, we can gain valuable insights to apply today.
Absolutely. It's like having a roadmap for navigating turbulent terrain. And one of the most important lessons from history is the power of diversification. Never put all your eggs in one basket. By spreading your investments across different asset classes, sectors, and even geographical regions, you can mitigate risk and potentially enhance your returns over the long run.
Diversification.
Yeah.
That's the golden rule of investing, especially when things are as unpredictable as they are right now.
It really is. And another key takeaway, particularly from Bloomberg's Wall Street Bets on New Riches Ahead and Markets All In on Trump, is that even amidst this wave of optimism, there are potential risks we need to be aware of. Valuations are currently sky high, as we discussed earlier, and if Trump's policies don't deliver the anticipated growth, those lofty valuations could deflate very quickly.
Yeah, it reminds me of that old saying, buy the rumors, sell the news. We saw a massive rally following Trump's win, but now investors will be watching closely to see if his actions actually live up to the hype. And that brings us back to the question of inflation.
Yes, inflation is the wild card in this whole scenario. While the market doesn't seem overly concerned about it right now, some analysts are starting to get nervous. In fact, Barclays and Toronto Dominion Bank are already scaling back their expectations for interest rate cuts in 2025, citing concerns that Trump's policies could actually fuel inflation.
So it's a bit of a tug-of-war between optimism and caution. Investors are betting on a continuation of the bull market, But there's also this undercurrent of worry about rising inflation and the impact that could have on the Fed's ability to keep cutting rates.
Exactly. And this is where things get really interesting for individual investors. If inflation does start to tick up, as some analysts predict, it might be wise to consider investing in assets that tend to perform well in inflationary environments, such as commodities or real estate.
That's a great point. Historically, those assets have acted as a hedge against inflation. But on the flip side, if you're more worried about a potential market correction or an economic slowdown, you might want to increase your cash position or shift some of your investments into more conservative asset classes like bonds.
Precisely. It's all about assessing your risk tolerance, understanding your financial goals, and making adjustments to your portfolio accordingly.
This whole conversation has been incredibly eye-opening. It feels like we've just scratched the surface of a really complex and fascinating topic. So as we wrap up our discussion of China's deflationary dilemma, Trump's triumph, and the Fed's balancing act, what's the one key takeaway our listeners should keep in mind?
I think the most important thing is to remember that while market sentiment can be fickle, economic fundamentals ultimately drive long-term performance.
And with valuations at historic highs, it's crucial to be aware of the potential risks, like rising inflation and a possible slowdown in global growth.
Exactly. Don't get complacent, stay informed, diversify your investments, and always be prepared for the unexpected.
That's great advice. But there's one thing we haven't really touched on yet, how these global trends might impact specific companies or industries. I mean, we've talked about the forest, but what about the trees?
You're absolutely right. And that's where things get really interesting for investors who want to go beyond the macro level and start digging into specific opportunities.
So, for example, if Trump follows through on his protectionist trade policies, certain sectors like manufacturing could be negatively impacted, but others like defense or infrastructure might actually benefit.
Exactly. So as you're absorbing all the information we've discussed today, I encourage you to think about how these global trends might specifically impact companies or sectors that you're interested in.
That's such an important point. It's about connecting the dots between the big picture and your individual investment strategy.
Precisely. And that brings us to a really crucial question for our listeners to ponder. What does all of this mean for you on a personal level? How might these global economic currents impact your own financial decisions in the coming months?
That's the million-dollar question, isn't it? And there's no one-size-fits-all answer. But hopefully this deep dive has given our listeners the tools and insights they need to start asking themselves the right questions and making informed decisions.
I hope so too, because at the end of the day, knowledge is power, especially when it comes to your money.
It really is a lot to digest.
Yeah.
You know, we've got China battling deflation, Trump back in the White House with policies that could really shake up the global economy, and the Fed kind of walking a tightrope, trying to keep inflation in check without stifling growth. It feels like we're living in a real-life financial thriller.
It does, doesn't it? And just like in those thrillers, there are winners and losers. It's all about being on the right side of the trade, so to speak.
So how can our listeners use all this information to make smarter financial decisions? What are some actionable takeaways they can apply to their own portfolios?
Well, the first step is to really internalize this big picture we've been discussing. Understand that we're in a period of heightened uncertainty with both, upside potential and some significant downside risks. Then it's about aligning your investment strategy with your own personal risk tolerance and financial goals.
For example, if you're someone who's comfortable with more volatility and you believe in Trump's ability to deliver on his pro-growth agenda, you might be more inclined to ride the current market momentum and invest in those sectors that stand to benefit from his policies.
Exactly. But if you're more risk-averse, you might want to take a more cautious approach, perhaps increasing your cash position or shifting some of your investments into less volatile assets like bonds.
And don't forget about diversification. We've talked about it before, but it's worth repeating. Spreading your investments across different asset classes, sectors, and geographical regions is one of the most effective ways to mitigate risk and potentially enhance returns over the long term.
It's like the old adage, don't put all your eggs in one basket. It's timeless advice for a reason.
Absolutely. So as we wrap up this deep dive, I think the key message for our listeners is this. The world is a complex and interconnected place, and the economic landscape is constantly shifting. To succeed as an investor, you need to stay informed, stay curious, and always be prepared for the unexpected.
Well said. And remember, knowledge is power, especially when it comes to your money. So
Yes.
keep learning, stay engaged, and never stop questioning the headlines.
That's a perfect note to end on. Thanks for joining us on this wild ride through the global economy. Until next time, keep diving deep and stay informed.